So that moves us on to building a crypto portfolio. So how can we start building up our first portfolio, and what should we do? First, we need to look at how to build a diversified investment portfolio. So we want to first identify different assets and determine the percentage that they're going to take up in your portfolio and the percentage we want to allocate to each of them. So for an example, do we want to invest 80% into Bitcoin and 20% into Ethereum? Having a few, let's say maybe 1 to 3 different assets or coins is probably best, and it makes for good diversification and also means that you don't have too many. If you have 2 to 3, then it diversifies your money over a few different projects and it reduces the risk, right? Without over diversifying. Because if I invest in 20 different crypto coins and they go defunct, then it's not really good risk management. Whereas if I invest in 2 or 3 good ones and it spreads myself across a few different projects, it's good risk reduction whilst also investing in something which might actually work, right? So I say invest in 2 to 3 different coins, diversify yourself a bit, but don't over diversify. Don't invest in too many random things. It's just like when you invest in stocks, don't buy loads of random single stocks. It's best just to invest in a fund, right? It works the same. You also might want to consider different crypto sectors. So when you learn the basics and the advanced fundamentals, consider if you want to invest within the different sectors of the crypto space. So this is DeFi, decentralized finance, NFTs, which are non-fungible tokens, like when you buy a piece of art, or privacy coins like Monero, for an example, which is something that's like Bitcoin, but a different project, to further diversify your holdings. So you could look into investing in these different things when you get a little bit more comfortable with crypto. The next section is strategies upon mitigating and managing your risk profile. We talked about diversification, right? Diversifying your portfolio is one I can't keep stressing enough. This reduces the risk. So having a variety of different digital assets is good to mitigate risk and spread yourself out. Investing through the method of dollar cost averaging is probably the best. You hear a lot of people talking about that, right? You should dollar cost average into an index fund or into crypto every single month. Well, this is a good technique, so let's go over what it actually means, okay? Basically, this means to invest a fixed amount of money on a routine basis. We invest in intervals into the market on a routine basis. So for an example, I could invest $200 every single month into crypto, and doing this method basically reduces the impact of short-term market volatility on your overall investment, and also it often gives you a better deal over time on the price that you actually enter in on when you buy, okay? We have different trend data that shows people that dollar cost average have a better output in the end than someone who's using a different method, okay? So I'd recommend doing dollar cost averaging. Even if it's investing $100 a week or a month, it's better than doing a different method of investing. So how do we actually monitor and adjust our portfolio over time after we've actually got into it? Well, monitoring and adjusting your portfolio over time is very important. The reason for this is that it remains aligned with your investment goals and risk tolerance, and you make sure that you're not going off course with your original goal. We should regularly review our investment portfolio to ensure that it remains diversified for one and aligned with our investment goals. We want to track its performance using certain different metrics. So the return on investment, aka the ROI, and the volatility are two things we need to take a look at. You can use some of the tools I talked about before to actually do this, to track the performance of the market, like CoinMarketCap. Those are good tools to do that. Also consider the current market conditions, such as changes in the supply and demand, the economic and geopolitical events, and regulatory developments, okay? So these are all different things you're gonna have to take into consideration every time you're looking at where your money's going and where you need to take money out of.